Welcome everyone to this week's Insignio Speaker Series. I'm happy to be joined today by George Sakellaris. George, I hope I did not butcher your last name too much.
Nope.
Is that okay?
That was perfect.
Great. Take it from someone whose names, both first and last, get regularly butchered. So I sympathize with you. So George is joining us from Brown Advisory, and George happens to manage a mid-cap growth strategy. George, this is very interesting for us to have you because we recently, I would say about 2 quarters ago, we initiated a position in mid-caps. And that actually came about because we did an analysis of mid-caps versus large caps and small caps going back, over 50 years. And we found sort of like an anomaly in this space. We found returns that were similar to small caps, but with much lower volatility, or not much lower, but lower volatility, and better risk reward than the large cap space too, as well. So we are believers of this space. We've invested in our IMAP strategy. So maybe just give us a quick overview of your firm and your fund, and then we can get into some of the macro outlook here in the near future.
Absolutely. And Ahmed, thanks for having me. I really appreciate the time. Our firm, Brown Advisory, if you go back long enough, was once part of Alex. Brown and Sons, a fairly well-known investment bank dating back to the 1800s. Our group doesn't go back that far. We were founded as the private client asset management group within Alex. Brown and Sons back in 1993. And then when Alex. Brown and Sons went through a series of transactions in 1998, our CEO led a management buyout, and we've been an independent firm ever since. We had maybe a few billion in assets under management back in 1998. And now I haven't looked in the past few weeks. I'm sure it's a little bit lower, but we have about 130 or 140 billion dollars under management. And that's split maybe perhaps, again, I'm using rough numbers, but perhaps 60% in that high net worth private client group, and about 40% in the group where I work, which is the institutional team, where we manage a set of about 10 commercially marketed strategies that tend to tilt growth and run the market cap spectrum from small cap up to large cap. We have a global strategy that we started and grew substantially over the past 6 or 7 years. So that's us in a nutshell. We're a private partnership, and I only mention that because culturally that's very important to allowing us to have the long-term orientation that we have. It's often overlooked, but I do think our ownership structure, 70% of the current employees 70% of the company is owned by the 700 or 800 current employees. The 30% are families that have been around for a long time, a couple of other outside investors. No one shareholder controls more than about 4.5% of the shares. And we have about 100 partners, give or take. And that structure in our compensation system really allows us to take a 3, 5, 10-year view when we make investments, which is really important to us down cap in small cap growth and mid cap growth. It's certainly important up the cap spectrum as well. But that's the firm in a nutshell. Any questions on the firm before I go into our strategy briefly?
Yeah, no, I think that's great. I think that was just what we needed to hear, just a quick overview. Now, maybe we could just get into the strategy or how about this? Before we get into the strategy, let's talk bigger picture and macro. What's going on out there? We just had a Fed meeting. You guys are assuming are mostly bottom-up stock picking, right?
That is correct.
Right. But how attuned are you to the macro landscape, and, how does that impact or not what you're doing on the investment side?
Well, it's not a starting point for portfolio construction or for any investment that's coming through the pipeline when we do months of in-depth due diligence. But I'd be a fool not to be aware of the macro environment, have a view of that. That's largely formed by the hundreds of conversations that our team is having every year. And, so it's not a starting point for portfolio construction or analysis, but it's certainly a factor in everything we do. And every investment that we make, we have to consider how that company would fit within the portfolio from an exposure perspective, how it would act in different environments, things of that nature.
Right. Okay, so let's maybe talk a little bit about your view on rates and how that has impacted the portfolio so far this year, and how you think it will impact the portfolio going forward.
Yeah, it's been a good thing on a relative basis for our approach. So, without going into the 1 or 2 minute version of what we do, just for context for the answer to this question, Ahmed, I have to say we're somewhat valuation sensitive growth investors, and so an environment like from March or April of 2020 through mid or late 2021 tends to be more difficult for us on a relative basis because it's just harder to keep up as valuations extend. And then ever since November 16th, I think is the day that the Russell Midcap Growth Index peaked and started to pull back and is probably off approximately 35% from those highs, we've done better. And so generally, rising rate environment is a little better for us on a relative basis, but of course, it's bad for all equities for the most part, as we've seen since that started happening. My view is not unique. I think it's fairly evident that the Federal Reserve needs to keep raising rates, probably at a 50 basis point clip after the 75 basis point rise. And we've been preparing for this. So remember, our approach has very low turnover. So when I say these things, I'm talking about a few points of capital here, one way or the other over months. I'm not talking about massive abrupt changes. Our dollar turnover over the 10 years of operating the mid-cap growth strategy and about 16 years of operating the small-cap growth strategy, which we run together as one franchise. My friend Chris and I run both strategies together. The turnovers averages about 35% on a dollar basis and about 25% on a name basis. And so just for context, when I talk about changes, we're talking about slow and steady, not very abrupt, massive changes.
Right.
We've been very worried about the low-end consumer, about valuations in certain pockets of the market for actually more than just 6 months or 12 months since they peaked, really for 3 or 4 years in some areas. And so we've been underweight software until just recently. And then 6, 9, 12 months ago, we started to pare back our exposure in consumer. We were overweight consumer, not because of a macro call. I'm just giving you the over underweights as a reference.
Right.
We had probably 3 investments in the mid-cap growth fund and a couple more in the small cap growth strategy that were more exposed to the low to middle income consumer. Ross Stores, National Vision, which is an optical retailer that caters to a really low end consumer with a cost advantage. It's been a fine investment, but we started to worry about the lower income consumer in the States 9 months ago and pared back or eliminated a couple of those positions. We kept our software underweight, and only in the past few months have we been adding slowly but surely to opportunities in that industry as we see fair, and in some cases a few even bargain deals. But it's only been until about 2 or 3 months ago that we've seen that. To give you a little more context, there's a lot of software and a lot of technology in the mid-cap growth space. And that's always been the case. That's not new, but it drives that index a lot as well. And we watched the price to earnings ratio on a next 12-month basis for the Russell Midcap Growth Index extend to about 40 times. And typically it trades at about half that. Typically in good economic times when earnings are growing, it trades at about 22 to 24 times. And it extended amazingly with what happened after March and April of 2020. And now that's back to 20 times. And so we've seen all of that froth come out as rates started to rise, and that became a reality very rapidly.
Right. So let me ask you this. Let me take a little bit of even of a step back here. Talk to us a little bit about the mid-cap space. When we're talking mid-caps, let's drill down a bit so our investors and clients are aware. What kind of guidelines do you use for the mid-cap strategy here to determine what actually goes into your universe, or what's your potential universe of investments?
Yeah, it's really broad, which is one of the most attractive parts of this market. I mean, clearly the types of companies that you can buy and own for a long time is the most important thing. But the category is extremely broad. So in this strategy, which we think of as non-large cap, and I know it's a subtle difference, but because we run a small cap franchise and a mid cap franchise together, there's a decent amount of small cap content in the mid cap fund. And because of that team's heritage, our approach, all of that stuff, currently in the fund, the market cap ranges from approximately $1 billion to about $100 billion. It's a little lower than that on the top end now, maybe about $70, $80 billion. But we've held things that have breached $100 billion. On initiation of a new position, to stay true to the mid cap category, we try to target things between a $2 and $40 billion market cap. But we have no restrictions, so we can go outside of that if we want to. The only restriction is the 80-20 rule in our 40 Act fund in the States. And so we can go outside of that if we want to for a portion of the portfolio. We can hold things for as long as they want. And that's one of the tricks of the trade for small and mid cap is if you finally find a winner, you let it compound. And that's why we started the mid cap fund, because we had so many things compounding outside of the small cap range that we couldn't really hold and stay true to the small cap market cap range. And we still wanted to hold them. In some cases, companies like Edwards Life Sciences that's still in the fund, in the mid cap fund, had better growth prospects as a mid cap company than it did as a small cap company. And so, those are the only restrictions. And those give you a general idea of market cap ranges within the fund. And upon inception, again, we target 2 to 40.
Okay. And let me ask you this, because I mentioned to you when we started here that we recently invested specifically in the mid cap space. We did it through the MDY, which is a S&P 500 400 mid cap ETF, and we did it because we found the risk return was more attractive than large caps and small caps. So it's kind of like an anomaly that we discovered in this space. Why do you think that exists? Or is that something that you kind of mentioned that you opened up the mid cap strategy because you wanted to kind of keep holding the small caps, but have you sort of seen these dynamics play out of what I'm talking about the mid cap space?
For sure. Yeah. I think that, I lead the mid cap effort. My friend Chris, who I mentioned, leads the small cap effort. And even Chris would agree that the companies tend to be more attractive in the mid and mid cap range than in the small cap range. And so I like to think of it as having the best Sharpe ratio, right? We can combine both returns and volatility and get this nice ratio. And it almost always, in any trailing period that you look at, I should say almost any, I'm sure it's not every, but in most trailing periods that you look at, it has a better Sharpe ratio than smaller large caps. And if you go back 30, 40, 50 years, the longest time horizons, it actually just generates better returns. And so that's absolutely right. And why, I can only guess. It's an educated guess for sure, but I can't give you the perfect data set to prove why it does that. I can just tell you that by far and away, you find companies that have large and growing markets with diminished competitive sets from when they were small caps, with more appropriate board structures. So think the G of ESG tends to get better as you go into mid-cap land. They have better compensation schemes. They have more professional board structures. They have better controls. They've gotten rid of some of the ownership concentrations. The list goes on, but they have much more professional governance. They have sometimes better management teams. Companies have evolved sometimes from being founder-led to adding a management team that can really scale a large opportunity. And so you get these better setups within a company, yet they're still approaching the same market opportunities in some cases. So growth can remain the same on a percentage basis, we find, for a lot longer than people think, as things compound up out of the small cap range. In the past 10 years or so, I started 20 years ago, and this statement might not have been true then, but ever since the financial crisis, as you're well aware, probably there's been a trend of companies staying private longer. And so a lot of times what we see is that the more attractive capital markets activity, within the most attractive spaces, within services, within some parts of consumer discretionary, and certainly within tech and healthcare. The companies are staying private through the times that they would be small caps, and they're coming public as mid caps. Mm-hmm. And so you have this confluence of all those factors that just create a pond, if you will, of better business opportunities. And I think that's why you end up getting the superior Sharpe ratio in the asset class. But again, it's not something I can prove to you with a data set.
No, listen, your explanation is about as good as I've heard for it. So it's about as plausible as it gets. We don't know why it exists, but we know that it does. So it'd be interesting kind of drill down on that. But let me ask you something too. And I'd like to remind the audience to please submit your questions via the chat. If you do have them for George, we'll be talking for about another 10 minutes or so, and then I'll open it up for questions from the audience. You mentioned at the start that you were sort of a value, or I should say, a valuation-driven sort of growth manager here. How do you square the circle in terms of having it? Explain to us what that looks and feels like in actual portfolio management for you, because it sounds like you're sort of trying to take some aspects of I mean, it sounds maybe like a GARP strategy type of thing that you're trying to do. So maybe just drill down a little bit further on that.
For sure. I hesitate to use the term GARP. I used to run a research firm, an independent research firm, if you go back, 15 years ago, called GARP Research. And okay. I got to know a lot of the self-proclaimed growth at a reasonable price managers in the States. And some executed the strategy amazingly and had some of the best returns in their asset classes, and others did it really poorly. And so depending on who you're talking to or how they've implemented the approach, it's got a good connotation or a bad connotation. But I learned a lot by doing that and through lots of mistakes as a young analyst and director of research for that firm. And the way that we approach this is we're not momentum investors. And so it's not growth at any price. We'll apply the same principles of valuation that you would in any strategy, right? In any value-oriented strategy. I don't delineate between the two. There's a set of future cash flows, and our companies, they just tend to be higher in the future than if you're looking for something that most people would traditionally call value-oriented. And so we apply those same principles regardless of growth rate, if that helps. And so we're looking to give you a little flavor of what we look for and how that manifests itself in the portfolio. We're just looking to drive the best risk-adjusted returns we can in this market cap range. So we didn't start a growth fund to be growth for the sake of style. It's just the best fit index because we tilt growth, not core. So I don't want to leave anybody thinking that we're a value strategy or even core. It tilts growth. It's just not momentum growth. And the way that we do that is by we're looking for about 50 or 60 small and mid-cap companies that one day could be much larger. And we have a set of criteria that go into giving us confidence in a company's ability to compound their enterprise value over 5 years, 10 years, which typically our long-term time horizon is about 5 years, or hopefully longer. And those are, we call those the 3 Gs. So that's durable growth, sound governance, and scalable go-to-market strategies. And this is important to convey in response to this question only because of that, really because of the first G and the third G. So durable growth is really more about the durability than it is about some level of growth. So you'll find things in our portfolio that have mid-single digit organic growth prospects, and you'll find things in our portfolio like SentinelOne is 80 basis points of the portfolio currently growing at 110%. And so it's not about the rate of growth, it's more about the durability. And we get comfortable with the durability, the profile of that durability, really with the confluence of 2 things. And that's with a large and growing market with at least part of it that this company addresses driven by interesting secular tailwinds that could last for many years, and a diminished competitive set that gives the company an advantage, and a company can demonstrate to us that they can gain share profitably over a multi-year period, at least within a piece of the business that's important to returns. When you get those 2 things together, growth stays stronger for longer. We see that in the mid-cap space. And it automatically makes us not momentum investors because we're not seeking a certain growth rate hurdle. And you'll find that this portfolio is very eclectic because of it. We own a company that makes a third of the world's aluminum beverage cans. And there's a really interesting reason for us to own that company. I'm not going to bore you with the details, but that certainly doesn't have 50% growth to it, right? This is mid-single digit volume growth for aluminum cans. We also own things in cybersecurity that are growing much faster. And so it makes for this very eclectic portfolio, but not one that's momentum or just growth at any price driven. And then there's the third G. So the second G is just analyzing the people that can tackle that opportunity, right? Governance. And we've talked about a couple of the things already that go into analyzing governance, compensation systems, history of capital allocation, board structures, things like that. I'm going to skip over that one for a second because the third G is called scalable go-to-market strategies. And that's also important to answering your question. So we have to have line of sight to a company earning a superior return on capital. And so a company doesn't necessarily have to be generating its scaled cash flow return on capital at today. It doesn't even have to be GAAP profitable. We have a few companies that are early enough stage that they're not generating cash flows currently in the portfolio. But what we do need to do is have clear evidence and confidence in a company's ability to scale so that they can make eventually an appropriate return on capital for you, for me, and other shareholders of the fund. And so because of those two criteria, we're automatically not momentum or growth at any price. And then, as I mentioned before, at the end of our analysis, we apply the same valuation principles that you would apply in any value or core strategy. And when we think there's a 50 to 100% cumulative return over a 3-year period, generally that's kind of the hurdle. It's a little higher right now because of how far the market has traded down, but that gives you a flavor of what we look for.
Excellent, excellent. Let's actually go to some questions here. So what I have a specific. Let's start with this one first. How has the strategy done this year, given the difficulties that growth has had to start the year? Maybe we could, you mentioned that the Russell mid-cap growth, which I believe is your benchmark, correct?
Correct.
That's down around 35% for the year.
Yeah.
Yeah. What and how is the fund done in relation to that, and perhaps like the NASDAQ or some other sort of more, or the Russell 1000 growth?
Yeah, I don't know relative to the 1,000 growth. My guess would be it's probably underperformed large cap a little bit. It's outperformed the Russell mid cap growth index, especially sometimes these periods don't. It's outperformed year to date, but I think even more importantly, since November 16th is when the drawdown started, and so as we would expect, we would outperform in large drawdowns more like our beta. 0.9 to 0.95 is kind of our expectations in large drawdowns. As the numbers get bigger, the percentages have a harder time deviating from 100% in upside capture and downside capture. And then in more normal times, outside of the crazy market we've been in some months during COVID, for the 8 years leading up to that, the strategy had downside capture as the monthly stat is the standard in the industry of about 80%. And so those are our expectations. And ever since November 16th, the fund has been doing approximately that. I mean, it's volatile day to day. It's a concentrated strategy. It's not formulaic, but that's what we've experienced since the drawdown started. And that's with an extra caveat. And not that I tend to convey these things externally. It's just I used to be a scientist before I started in this industry, so I'm a very data-oriented person. And looking at how energy has acted, the strategy tends not to own energy, just given our 3G approach and the concentrated nature of the strategy and our long time horizon. We've never really found an energy company that fits that. But since November 16th, of course, the oil shock has sent that sector way up. And typically it would be adding to our relative returns, that underweight to energy at this part in a cycle, not detracting. And so our outperformance is despite losing 100 or 200 basis points to the index because we don't own energy. So we're outperforming even including that, but it would be doing better if Russia hadn't invaded Ukraine, I guess is what I'm saying.
Right. Well, a lot of people could say that. I have a question. So do you not own energy then, as when you say that as a blanket statement, like including renewables and hydrocarbons, or what do you mean as far as there are no energy names in the portfolio.
There are no traditional energy names in the portfolio currently. Although it's not like I wouldn't own it if I thought it fit the philosophy, fit the approach, and fit the return
Right.
hurdles.
It just doesn't fit your metrics.
We just haven't found one. And I certainly would own alternative energy. And we greatly considered Enphase and SolarEdge, microinverters, the two main manufacturers of microinverters in the solar industry. Certainly secular trends. There's certainly a lot of positives. And we even own Enphase in another Brown Advisory strategy. It's just the question about scalability and competition in the future versus how they got to where they are today has always led us to avoid it, that and valuation. So we certainly consider alternative energy. They're better secular trends, but currently no holdings. Right. The only exposure the strategy has to fluctuations in the price of oil is a payment company. It's WEX, WEX is the ticker. It's a SMID cap payment company that we've held for a very long time in both strategies. And about half their business is exposed to oil price fluctuations because they have a dominant fuel card network in the US and a growing one in Europe. So that some of their contracts had, ebb and flow with the price of gas at the pump.
Right. And I know that you're sort of doing this sort of bottom-up approach. So you're not necessarily doing a top-down sector, but how does the sector composition of the portfolio, let's say, differ from the broader index?
Yeah, it's always been overweight healthcare. I don't know if that's a personal bias because, as I mentioned, I was a physiology neurobiology major in the 90s. And so I worked in a Defense Department funded genetics lab before I joined this industry. And so I don't know if it's because of a personal bias or if it's just because our team finds really attractive companies that fit our profile. I think it's the latter. I'd like to think it's not a personal bias.
Cognitive scientists will tell you that it was definitely because you have a personal bias, right?
Right. And so it tends to be 5, 6, 7 points overweight healthcare. At some points in the strategy's 10-year history, it's been overweight tech. It's been underweight tech for 4 years, I think, at this point. And now it's getting close to equal weight as we've been finding opportunities. Those are probably the major differences, and those were 5 to 10 point differences from the benchmark. We tend not to have as many financials, depending on how you categorize them. We tend to be overweight industrials, but it's really because there are a lot of interesting services and database companies that get lumped into that category that fit our approach. It's not because we own a lot of cyclical, low growth industrials.
Right. I have a question here about saying that usually mid caps are highly leveraged. How much do you think it will affect or impact in this interest rate environment?
I don't know about the asset class in general. I mean, it's certainly a factor that goes into every investment that we make. And the only companies with on paper extensive leverage, there are only a couple in the portfolio, and those are backed by the assets. So really, there's only one. It's 3 points of the fund. SBA is a tower company, and they can hold 7 turns of leverage because it's all backed by the real estate, and it's a very steady business, right? Ball Corp, for instance, is the company I mentioned that makes a third of the world's cans. They have 3.5 turns of leverage, and that's perfectly appropriate for that business. Those are on the higher end of our fund. Our fund tends to have less leverage than the average holding in the benchmark that we're compared to, if that helps as well. But I don't know if that's true for the asset class overall.
Okay, right. So what you're saying is that your particular portfolio, it's not an issue in terms of leverage.
It should not be an issue.
Right.
Unless we're in an Armageddon scenario and it's an issue for every equity.
Right. And you mentioned you hold between 50 and 60 positions in the portfolio. Is that typical or is that an anomaly based on today's environment?
It's gotten a little more concentrated. We have another very attractive aspect of the asset class is that we have an increasing, and I'm sorry, I don't remember the numbers off the top of my head, but I put a white paper together that had some of these stats in it recently. Maybe we could follow up with that. But there's more and more capital markets activity in the space, for the reasons I mentioned before. And because capital markets activity went up threefold for about 18 months over the past couple of years, we had a slightly higher name count at points in late 2020 and 2021, because we typically participate in 3 or 4 maybe 5 IPOs in the strategy each year. And we just found, twice as many that were attractive during the period when there were 3 times as many IPOs. And so there were points where we had 65, 66, 67 positions. Some of them were smaller allocations from recently public companies that breached our 3-year price targets, many of them because of the crazy market environment that we were in and we had to exit. So there was a point where we had more, but typically it's around 60. I think if you went back to when the strategy was in incubation mode, before we had a UCITS, before we had a mutual fund, we had 2 external institutional accounts that we funded the strategy with back in January of 2012. And there was a point in the first couple of years where it had 70, something like that, when it was being incubated. But by and large, you should expect the strategy to have approximately 60 positions. And we like to think of that as not overly concentrated, but also not overly diverse like most of our mutual fund peers. It's, I always describe it as kind of Goldilocks or somewhere in between, highly concentrated and overly diversified. And one of the other ways, it's something you should be aware of because it creates even more tracking error than running a 60 stock portfolio. So we tend to concentrate about a third of the portfolio in the top 10 holdings. So it's a slightly maybe more concentrated because of that than the name count would imply.
Right. Okay. Excellent. Well, George, I'm afraid we've run out of time, but thank you so much for joining us to discuss this space, to discuss your fund. I'm sure a lot of our advisors and investment professionals are going to be looking into it here in the future. Like I said, we recently got into the space ourselves. So good to see. Thank you again for joining us. I appreciate you coming on.
Ahmed, thanks for having me. I think you're right in the right time to look at the category. And I'll just leave you with this. I mean, coming out of the financial crisis, mid-cap growth was the best performing growth index for 2009. I think it outperformed large cap and small cap growth by 8, 9, 10 points that year. First quarter of 2019, after we had a 25% drawdown leading up to Christmas Eve of 2018, mid-cap growth was the best performing asset class. So I don't know the aggregate data set, but in my recent experience, it does tend to be one of the better performing categories after large drawdowns. So thank you for having me, and kudos to you guys for looking at it at the right time.
Great. Thank you, George. We appreciate you joining us. Everyone have a great week, and we'll see you next week.
Thanks so much. Have a good one.
Take care. Bye-bye.